Hi, everybody. It is Kanisha, the Beauty CPA Coleman, and I help beauty entrepreneurs save money with effective tax planning and CFO services. Okay, guys, I am coming back to you today so that we can continue the conversation that we were having. When did I go live? Was it yesterday or the day before yesterday? One of them days. On Tuesday. So, yeah, it was yesterday. We were talking about it's tax season, and I was giving you guys the opportunity to come on and hang out with me for a little bit so I can answer and address all of your tax and bookkeeping questions. Now, the IRS officially opened on Friday, February the 12th. So it is go time, y'all. It is time for us to start getting those books and records together, start collecting those tax documents that's being sent to you all, and get ready to, file that tax return on time. Now, remember last year, because of the pandemic, they pushed back the due dates for individuals and C corporations. I don't think they're going to do that this year. I'm going to be honest with you. I do not think they're going to push back any tax return due dates. So time is of the essence. Let's not waste any time. Let's start getting together everything we need to be able to file your tax return on time. Now, remember, I always have this rule of thumb. Even if you are going to make the deadline, which is the middle of March for partnerships and as corporations, March 15th is your deadline. And for C corporations and individuals, your deadline is April the 15th. But just to be on the safe side, I'll always have tell you guys to file your extensions, okay? If you're rocking with me this year and I'm preparing that tax return for you, I'm going to do that anyway, regardless if we, plan on being late or not. You never know what can happen. But just file the extension. It will give you an automatic 6 months. Now, remember, that's an extension to file the return, not to pay. So keep that in mind as well. But yes, file your extension and let's start gathering things. So where we left off last time, and if you missed that session, guys, go ahead and go back on my IGTV if you're watching me on Instagram, or if you're on Facebook or YouTube. The video is there in the Facebook group and on the YouTube channel. Go ahead and take a look at part 1. This is part 2. This is a continuation of where we left off yesterday. Now, remember, yesterday, the last thing I talked about, and I had a little snafu yesterday. I remember I was recording from my MacBook, and I remember saying like, oh, I need to plug this up. It's finna die. Totally forgot that it was about to die, and messed around, didn't plug the power cord in, died. So if you're watching that video in the Facebook group or on YouTube, you'll notice that like between minute 31 and 37, it's completely black. It's because my computer died. But I plugged it back up and I continue where I left off. But where we left off yesterday, we were talking about the earned income credit, right? I got the question from someone. Someone asked me, if I got unemployment in 2020, is unemployment considered earned income for purposes of the earned income credit? And my answer to that question is no. Unemployment benefits, money you get from the state or federal government because you were laid off or furloughed during the pandemic last year, that money is not considered earned income for the earned income credit. Why does that matter? That matter, guys, because just think about it. Earned income credit is based off of your earned income, meaning that the more earned income you have up to a certain point, the more credit you can get. And this credit is fantastic. It's one of my favorite credits because it's fully refundable, meaning that even if it decreases your tax bill, if some is left over, you get that back in cash. Okay, so that's why that's important. But just think about this. If you made less money in 2020, right, your earned income credit is going to be lower than maybe what you're used to. Because again, that credit is based off of your earned income. Now, one thing that I left off from yesterday, and this is when I got cut off, because of the pandemic, Congress has written into the latest bill that was passed said that, okay, you guys have the choice to base your earned income credit off of either your 2020 earned income or 2019, which is amazing, right? Because if, let's say, in 2019, that was a normal year, it wasn't no pandemic, it was a normal year, you probably made, some money, and it probably got you back a sizable credit, right? Well, flip to 2020, totally changed, right? Maybe you were laid off, maybe you were furloughed, maybe you were shut down because of the pandemic, and you probably didn't make as much, meaning that you would get a lower credit. But make sure you see how much credit you will get if you switch it to be based on your 2019 earned income. Now, if you are rocking with me this year and I am preparing your tax return, I am going to do that analysis for you anyway, right? Because I'm keeping up on this. I'm watching the tax news. I'm staying abreast of all the updates that are happening almost on a weekly basis, right? So I'm going to know to do that analysis. But if you're doing your tax return yourself, or you're paying you're going to somebody else, why would you do that when you have me? I don't know. But if you are, and you notice that your credit is, your EIC, your earned income credit is lower, make sure you have them do an analysis to see if the credit will increase if it's based on your 2019 income versus 2020. So keep that in mind. Keep that in your back pocket. It may make a world of a difference when it comes to how much earned income credit you get back. All right. So great. Hey guys, for you all who are just joining, make sure if you have any questions, guys, just drop them in the comments. Drop them in the question box, okay? I have questions already. These are questions that were left over from part 1 that people asked or were sent to me. And that's one of the perks of being on my email list or on my Facebook group, guys. When you have direct connection to me, like on my Facebook group, which the community is pretty, engaged, or if you are on my email list, when I email you things sporadically throughout the weeks, you have the ability to really get with me and ask, questions, right? When you're doing it through Instagram, I try to do my best to keep up with my DMs, but I get a fair number of them, and so it may get lost in the sauce. But that's not the case with email in my Facebook group. So please sign up to be on my email list, or join the Facebook group. The Facebook group is called the Beauty CPA group. It's on Facebook. Just search that. It should pop right up. And then on my email list, just go to my website, thebeautycpa.com, and sign up, and you'll get on the list, and you'll get all the happenings and all the perks of being in the community. Okay. But if you have any questions right now, you're here with me now, go ahead and drop them, and I will answer them. But for now, I'm going to go to what I have in front of me. Okay. Question number 1. How is my business income reported? Now, specifically, this person is a single member LLC. So what is that? That is a person who has went to their Secretary of State and they filed an LLC, and they are the only member. So one owner. Okay. If you are a single member LLC, if you are a sole proprietor and you're operating your beauty business based off of a DBA, right? Or even if you're using your legal name, you're going to file your business financial activity on Schedule C attached to your Form 1040. Okay? If you are a partnership or a multi-member LLC, meaning that, general partnership, meaning that it is 2 or more of you, and y'all just woke up and started a business one day, or 2 or more of you, you went to your Secretary of State, you filed an LLC, and now it is 2 or more owners on the LLC. If this is you, you're going to file on a partnership income tax return. That is going to be IRS Form 1065. When it comes to the states, most states try to kind of give it a similar name to the federal form. So your state form, it may say 1065 or not. Even if it doesn't, it should say partnership on it. You're going to file on a partnership tax return for the feds. That's Form 1065. Okay. Now, if you are a corporation, specifically an S corporation, right? You have an LLC and you have made a tax election to be taxed as an S corp. Okay. You're going to file on Form 1120S. Okay, 1120 in the letter S. And then if you're a C corporation, right? You're an LLC, you made an election to be taxed as a corporation. You are going to file on Form 1120. 1120. So that is how each of the business entity structures will file those four different forms. So proprietors and single member LLCs, Schedule C of 1040. Partnerships, multi-member LLCs, partnership tax return, 1065. S corporation, 1120S. C corporation, just 1120. Okay. Now I do have a question here. So I know you mentioned you recommended changing entities of income of $30,000. Okay. Would that include the wages if you are on payroll with an employer that you receive a W-2 from? Okay, so let me make this very, very clear. We're talking about at what point in your business should you consider switching entity types, right? And so my original theory around that is when your beauty business generates around $30,000 of net profit. I want to make that very clear. When I say net profit, I mean income minus expenses, and that's your net profit. So that's what you are ultimately taking home after you have paid all your beauty business's expenses. When you're around the 30K net profit, that's when you should start really watching your net profit, running the numbers to see how much tax you can save if you were to switch entity tax. Now, if you are a W-2 employee and you are bringing home $30,000 after, this is not gross, this is bringing it home. So after every deduction that you may have. Actually, I don't even want to go down that road because I'm just going to say right now, what I just said, that applies to sole proprietors and single member LLCs. Form W-2 employees are in a whole different boat. And we can talk about that. We can talk about what are the advantages of being your own, of being a beauty business owner versus, right, being a beauty business owner versus being an employee. One of the significant biggest differences is the tax savings. Because when you are an employee working in a salon or a spa, they're going to take out payroll taxes. And that's it. You cannot deduct anything else related to your career as a beauty professional. So no matter if you're buying your own supplies, if you're buying your own materials, if you are, making business cards for yourself, if you're advertising, if you're taking extra training, you can't deduct none of that because you're an employee at the end of the day. You only can do that when you have your own business. Now, if you're doing both, if you're doing W-2 and you got your own business and you're doing this simultaneously, maybe you're building, you will still only count the sole proprietor money, not the W-2. That's like a whole nother tax game. Okay? So when I say watch your money around 30K to think about switching business entity types, I'm only talking about net profit from self-employment income, money from your own business, not W-2 money. Okay? Okay. I hope that answered your question, Kitty. If it did not, let's jump on a call. Let's talk it out. Let's unpack it, right? There may be some other nuances that I need to know, and maybe I can give you a more accurate answer. But please go to the link in my bio, book you a 15-minute brief call, and we can unpack that if you want more information. Okay, that was a great question though. It was an awesome question. Okay, so what can I deduct? I get this question all the time. What can I deduct? And you know what I say? I want y'all to switch that mindset and not think about what can you deduct, and maybe think, just be aware of what you can't deduct. Because I'm going to say this, and I mean this. If you spent money and it relates to your business, it's tax deductible. There are very, very few things in the tax law that are non-deductible. Stuff like penalties. You can't deduct federal taxes. You can't deduct things that are personal in nature. You can't deduct things that are illegal activities, right? Illegal under federal law. You can't, right? But you can mainly deduct everything. If it's related to your business, you can deduct it. I'm going to give you just a general rule. And I have an awesome resource, guys, that'll help you with this what can I deduct questions. I have a resource. It's called the Ultimate Tax Deductions Guide for Beautypreneurs. I believe it's still a link in my bio where you click on that link. It's a freebie. It's a free download. You don't have to pay for anything. It's about 19 pages, and it teaches you how you know when an expense is tax deductible. And then it'll also give you a couple of cheat sheets of everything you can deduct in your business. But it really teaches you the theory behind tax deductibility. Here is the general rule of thumb. If it's ordinary, meaning that common in your industry, if it's necessary for you to run your business, and it's not extravagant or lavish, it's tax deductible. Okay, so keep that in mind and be aggressive. Be aggressive. Don't be scared. A lot of people, they'll have these deductions that are legitimate, that they really did incur in their business, but then they see the amount of the expense and they think it's too high and they don't deduct it. Let me tell you something. When you don't deduct something in your business because you're afraid, even if it's legit, but you're not doing it because you're afraid of the IRS or red flags or audits or whatever, you are overpaying in tax. And I don't want you to be that scared of the IRS that you're willing to pay for that fear, right? Because when you don't deduct it, you're overpaying in tax, which means that your fear or your anxiousness from being audited, now that's costing you money, okay? So let's not do that. I don't know if you guys know this about me, but the first 8 years of my career, I spent as an auditor with the IRS. Please believe me, there is no team of agents sitting around looking through returns manually, looking for red flags. It's not. When returns come in, because there are hundreds of millions of returns coming in at a time, that is mainly computerized, right? Mainly computerized. And once a real set of human eyes get on it, 9 times out of 10, they're going to say, this is not material enough. What I mean by that is worth it enough to examine. Did you guys know less than 1% of all returns that are filed are audited? Less than 1%. So your chances are like slim to none. So don't be that scared that you overpay in taxes. That's my point. Look, get that freebie. Look at my links and see if you see the tax deductions guide freebie. If you don't see it, DM me for it and I can send you a link right away. Okay? Next question. If you got funds for a PPP or the EIDL, is that money taxable? Do I have to report that as taxable income on my tax return? So if you guys are newer and you haven't heard of these things, PPP is the Paycheck Protection Program. EIDL, that's Economic Injury Disaster Loan. These are the programs that the Congress and SBA made available to small businesses to help them through the pandemic, okay? If you got this money, it is not tax deductible. It is not tax deductible, guys. Okay? You may get questions from your tax professional. Like, for example, if you're working with me this year, right? If you're working with me this year, you'll probably get a question from me saying, hey, did you get it? It is not so I can report it on the tax return, right? That's not why we are asking for that. So don't be afraid of answering that question. You are not being taxed on PPP or EIDL. That is not taxable money. Hey, Small Boss Academy. Hey, Jessica. It is not taxable, okay? Now, if you have already applied for PPP forgiveness, that also is not taxable. So remember that as well. Hey, guys that are just joining, please, if you have any tax or accounting questions, drop them in the chat. I'm going to keep going and answering these questions for y'all. Okay, my next question. Are expenses paid for with PPP or EIDL funds? Are those expenses tax deductible? That is also a great question. So I'll give you a little bit of background on that. So at first, y'all, when they came up with EIDL and PPP, well, let's take EIDL out of it for a second because that is a loan. That is not forgivable whatsoever. But let's talk about PPP. PPP was the loan that they were offering to folks. But if you spend it the way you should have, right, on eligible expenses, the loan can be forgiven. Well, then they were saying like, well, if we're forgiving this loan, we're not going to allow taxpayers to deduct the expenses they pay for with the money. That's what Congress said at first, right? But just remember, all of this money, most of it had to have been spent on payroll costs, right? Payroll costs, salaries and wages, and self-employment earnings, which can be the biggest expense on your P&L. So just imagine if you got this money and it got forgiven, but then you couldn't deduct those costs. Then you would have seen your tax bill go way up because you can deduct the payroll costs. Well, a lot of accounting and taxpayer organizations, they started to lobby Congress, and finally Congress said, you know what, okay, we give up, we surrender, we will allow taxpayers to deduct expenses that they pay for with PPP and EIDL. So to answer that question, yes, you can still tax deduct expenses that you paid for with PPP money, even if you got it forgiven. So no worries there. You make sure that your tax professional is deducting those expenses. Hopefully you're working with me. And if you are interested in working with me, please hit that link in my bio. You can fill out the very short questionnaire that I have. I can give you a quote fairly quickly. I still have my 15% off going on. I'm probably going to do 15% off until the end of February, right? Until February 28th, I'll leave my early bird offer up there, okay? Going to save you guys a lot of money on tax prep fees, all right? Next question. Is money taken from my retirement account taxable? Now, I am going to say that I got this question because I spoke with this person a little more in depth when they asked me this question. Because of the pandemic, right? Congress said, okay, you all can pull money out of your retirement accounts with no penalty. Now, before that, right? Pre-pandemic, no pandemic, right? In a regular year, you cannot take money out of a pre-tax retirement account without being penalized, okay? It would penalize you if you took it out early, right? But when the pandemic started, Congress said, you know what? It's hard times out here. So you can take that money out and we will not penalize you. We will not penalize you now. It is taxable. It is taxable. But get this, because of the pandemic, you do not have to pay the tax back all in 1 year. You can spread that payment out over 3 years. And furthermore, let's say you didn't want to even keep the money. Let's say you took it out and maybe you didn't need all of it, or you didn't even need none of it. You didn't even use it, right? For whatever reason. You can give it back. You can give it back. No penalty, no tax. But if you took that money out, you have no penalty. And if you kept that money, it is taxable, but you can spread the tax paid back over 3 years, which is fantastic. Because before, you had to pay back all in the year you pulled it out, right? So if I put out $100K in 2020, I would have to pay tax on $100K by April 15th of this year. But not because of the pandemic, they allow you to spread those payments. So I do have a question. Is that for this year as well? Now, they have not revived that opportunity. That opportunity ended if you pulled money out by December 30th of 2020. So that ended last year, last December. But who knows? Who knows, right? They've just changed something that I'm going to have a whole nother new session about because it's too deep to do in one session. They revised something called the Employee Retention Credit, which is going to be huge for some people that have employees. But who knows? They may revive it, Jessica. So just hold on. Just hold on. They may revive it because we are still in the pandemic. I don't care what nobody say. I know they opening stuff up. I know they opening restaurants and movie theaters, and I know they having sports, and I know some kids are going back halftime. I know they're trying to get back normal, but truth be told, the cases are not getting better, you know? Cases are not getting better. So we're still in a pandemic. So they may revive that program. And you know what? I'm thinking it may happen because they're still giving stimulus checks out. They're still writing bills and still passing them to give out stimulus checks. The government will run out of money. They will run out of borrowing power. They will. And it's like, where's the money going to come from? They're going to raise taxes on who? Anybody got no money? You know what I'm saying? Right? On the rich, we'll see. Okay? How's that worked out? Right? So another option is to allow people to tap into the funds they already have, like 401ks, home equity loans. We can get financial institutions will get creative. So Jessica, you know, breaking tax news, I'm going to bring it to y'all. So don't worry. I got you. As soon as anything changes, I know y'all can benefit from. Okay, so I got 2 questions left. And then I'm going to let y'all go ahead and enjoy y'all Wednesday. My next question, this is a very good question here. Should I take the standard deduction or should I itemize? Okay, let's talk about it, right? The standard deduction is the flat rate that the IRS allows every individual to take based on your filing status, right? If you're single, I believe is $12,200 for 2020. If you're head of household, I believe is 18. I got something right here. Hold on. I got like a little chart right here. Yes, I'm like that nerdy that I have this stuff on my desk. Okay, yes. So for 2020, the single status was $12,400. Head of household was $18,650. And then married filing jointly for 2020 is $24,800. Okay, that's what it says. But if you're going to itemize, that is a total of a bunch of different deductions. And you will use Schedule A of the 1040 to figure that out, right? Some of the really big deductions on that form is property taxes. If you own your home, the property taxes you pay. It could be the state income taxes you pay or general sales tax. You have to choose which one you want to take. It could be your home mortgage interest that you pay. It could be medical expenses. It could be charitable deductions. If you like give a ton to charity or a ton to your church, it could be a lot of different things on Schedule A. But it's the total of those expenses versus the standard. you take whatever is higher, okay? If you're working with a tax professional, a good one like me, we're going to do that analysis for you. We're going to do that analysis for you. We're going to take all your information and we're going to see which one is higher, and then that's the one you take. You always go with the higher one. You can flip-flop from year to year. If you take standard this year, you can take itemized next year. You're going to do whatever numerically works out to be the most beneficial for you. But any good tax professional will look at that and make that analysis. If you're doing this yourself, whatever tax software you use will also do this analysis for you. Okay? And so my last question here is, does my child have to file a tax return? So I'll give you some background on this one. The child, the woman I was speaking to, she has a 16-year-old. He worked a part-time job during 2020. So my question to her, my follow-up to her was, okay, how much did he make? Did he make below the standard deduction? Because that's likely what he's gonna, when he files his tax return, he's gonna take the standard deduction. And if the income he made is less than that, he does not have a filing requirement. He does not have a tax return filing requirement. So he does not have to file taxes. If your minor child's income, earned income, remember I said earned is a different rule for unearned. But if it's earned income and it's less than the standard deduction, which is $12,400 for a single person in 2020, there is no tax return filing requirement. Now, if the minor child has made less than the standard, however, you see that they took federal or state taxes from this child, file your tax return anyway. File it anyway so you can get that money back. File it anyway so you get the money back. Okay, guys, that was my last question. I thought those were some good questions. They varied across several subjects, hot subjects that are relevant. What I am thinking, guys, and this may not happen till maybe the weekend, may not happen to Saturday or Sunday, but there is a hot new topic I want to put out here for you guys. It is called the Employee Retention Credit. And this is for people who have employees. But listen to me. For those of you who don't have employees, do not count yourself out just yet, because there are some loopholes. You know, I am all for the loopholes because I've seen big corporations do it. I've seen the rich and famous do it. And so I think all of you should be doing it too. So I am going to have a special session on the Employee Retention Credit, and I am going to share with you some of the strategies and loopholes that me and my colleagues have been discussing in our masterminds. It is it's not super new. It all started when the pandemic happened, but there have been some new developments, and I think you want to know these because they could save you thousands of dollars, okay? Thousands of dollars. Employee retention credit is a refundable credit, okay? So I want y'all to look out for that. As soon as I know when I'm doing it this weekend, I'm going to put out a notice. If you're on my email list, you're going to get an email. If you're on my text list, you're going to get a text. If you're in the Facebook group, you're going to get a notice there. I'm going to put a notice out on Instagram, but you know how Instagram works. They only show you stuff to a portion of your followers, or a portion, I don't like followers, a portion of your community. And so you may or may not see it there. So I'm going to try my best to get the word out, but just look out for that. That's going to be super dope, okay? Anything that saves you money is dope. So, y'all, thank y'all for rocking with me the past 35 minutes. I hope it's been helpful. Do not stop asking the questions. Keep asking them. Keep DMing me. Keep emailing me. Keep dropping them in the Facebook group, right? So you can see and get the answers to your questions. If you are interested in me preparing your tax return, hit that link in my bio. The 15% is still good to the end of February, okay? Even if you don't catch the 15%, trust me, I'm going to save you more money than what you're going to spend with me. I'm going to leave it there. I'm a money saver, okay? All right. So y'all have a good rest of y'all night, and I will talk to you sometime this weekend. Okay. Have a good week, guys.